Welcome to the Daily Insights That Matter. The World Bank, in its latest India Development Update report, has stated that India's growth is expected to moderate but will remain one of the fastest growing economies. The Indian economy's growth is expected to moderate to 6.3% in fiscal year 24 from 7.2% in the previous financial year, showing its resilience against the backdrop of a challenging global environment. This resilience was underpinned by robust domestic demand, strong public infrastructure investment, and a strengthening financial sector. Additionally, the World Bank has increased its retail inflation forecast to 5.9% for fiscal year 24 from the earlier estimate of 5.2% made in April. After a peak in July of 7.44% on the back of food prices due to adverse weather conditions and oil prices reaching close to $95 per barrel, inflation has eased and is expected to hover below the RBI's tolerance band of 6% for fiscal year 24. Furthermore, the fiscal deficit is expected to decline to 8.7% in fiscal year 24 from 9% of GDP in fiscal year 23. Fiscal consolidation is likely to be led by modest growth in recurrent spending and buoyant revenue growth, making room for investment, with public debt to stabilize at around 83% of GDP. India continues to show its resilience amid a gloomy global outlook and a challenging environment. With a growth rate of 6.3% for fiscal year 24, India still maintains its stance as one of the fastest growing major economy in the world and almost twice the average for emerging market economies. However, global headwinds will persist with various factors like high global interest rates, geopolitical tensions, and sluggish global demand. Corporate India's credit profile continued to remain strong in the April to September period of 2023, though it slightly moderated in the first half of fiscal year 24. Let's discuss this. CRISIL Ratings reports a key indicator known as the credit ratio, which tells us about the balance between rating upgrades and downgrades. In the first half of this fiscal year, this credit ratio stood at 1.91, which is slightly lower than the 2.19 observed in the second half of the previous fiscal year. A credit ratio above 1 indicates that there are more rating upgrades than downgrades. Specifically, CRISIL Ratings upgraded the credit ratings of 443 companies while downgrading 232 firms during the period. Another respected rating agency, ICRA, also provides insights into the credit landscape. In H1 of fiscal year 24, ICRA observed that the number of rating upgrades was twice as high as the number of downgrades. This demonstrates a favorable trend in the credit worthiness of Indian corporates. These positive developments can be attributed to several key factors. First and foremost, there is an anticipation of increased cash flows in the current fiscal year for sectors closely tied to domestic demand and those benefiting from substantial government spending. Industries like infrastructure, services, and consumables have played a pivotal role in maintaining this overall positive trend in credit rating upgrades. Analyzing the broader picture, ICRA's experts affirm that in H1 of fiscal year 24, India's credit quality has continued to strengthen. This builds on the impressive performance witnessed in the two preceding fiscal years. This growth is driven by sectors with a strong focus on domestic consumption and investment. Notably, both investment grade and non-investment grade categories have seen an enhancement in their credit profiles. However, it is worth noting that the pace of improvement has moderated compared to the previous two fiscal years. In summary, the credit profile of corporate India has remained strong in the first half of fiscal year 23. Factors like robust domestic demand, government spending, and improved credit ratings across sectors have contributed to this positive trend. While the pace of improvement may have slowed down slightly, the overall credit quality of India companies continues to exhibit resilience and progress. With that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com